Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, May 9th, 2023. It's 2:18 p.m. Eastern Time, so I'm starting the video. And here's what we're going to do in this one, in this order. We're going to take a very brief look at the equity markets. I got some charts out to you today with some levels on QQQ and NQ. They continue to bounce around at this point in time. They're waiting the next big thing or the next thing to give everyone clues on interest rates, and that'll be the CPI print tomorrow, Consumer Price Index, which measures inflation. So I'm going to go over, after I go over the indexes, I'll do a brief update on that. I'll give you my expectations of what we might see there. I've had a pretty good predictor for guessing which way those numbers are going to go. And then last but not least, I want to go over my macro in both near and longer term outlook and kind of go over the that RP vacation indicator I mentioned before, because I'll tell you what, it's really I'll get to that in a second, but it really seems that every time I leave on vacation, the market makes a turn, and it's a turn that each and every time I've been positioned for, caught, and played out, but I started noticing this because it's typically, as I'm on a plane or traveling or sitting on a beach somewhere, it's outsized gains in my portfolio. I'll talk on that in a minute. How I trade when I'm going to be away from my desk. But starting out here, very very briefly, this is the 15-minute chart NQ that I gave you this morning. You have divergence right here. There's your divergence line. You can look down here on the indicators, PPO and the RSI, negative divergence, just like you had divergence there, divergent high. And that's typically, not always, but typically marks trend reversals. And that trend reversal ended in a divergent low. Guys, this is super simple stuff, highly effective, far from 100%. Nothing is in trading and investing, but this is typically how it works. And it's not magic. These are momentum indicators, and the divergences, negative divergence when prices are making equal or higher highs and your indicators are making lower highs. It just shows you the momentum is waning. And so we went down, hit that first uptrend line right there. So this is your divergence line. This is your uptrend line, forms a wedge. That wedge could certainly extend. Last time the divergence was about the same in scope, about the same size divergence. And remember, a divergence on a shorter term time frame, or any chart pattern for that matter, whether it's a 5-minute chart, 15-minute, or an hourly chart, or a daily, the scope of the move is commensurate with the time frame. What I mean by that is day traders use 5-minute, 1-minute, 10-minute time frames. Swing and day traders use 60-minute daily and weekly, and I wear all those hats. Sometimes I'm day trading, but we hit that, and right below that I had a support zone here from 13,253.80 roughly, and down to 13,237. Very tight. Support zones when I have two support levels in very close proximity. So we hit that. It was right below the trend line, or right on it. They both came in around together, and actually you can see we hit that to the button. And so I said each of these levels, when I got out to morning, or where you're likely to see reaction, this is a reaction right here. You hit the trend line on the initial tag and you bounced. Then you went down, you took it out, and then you hit the next support level and you bounced. Next time you go down, you hit the next one. You may or may not bounce because it's so close. When I have those two support levels in very close proximity, and I refer to it more as a zone, it increases the odds that lower level may be taken out. You could get a reaction off it, but again, we'll see. And now let me get to a couple other charts, and we'll get to the CPI and move on. So that was NQ, and then when you look at QQQ, I gave you this one. I actually gave it to you in a 30-minute. There it is. Zooming in real tight, same thing. You can see your divergences down here, lower highs on the PPO and the RSI, and higher highs in prices. So this is your most recent divergence line. It really extends. It goes back all the way back here. It's the same negative divergence that we have on the daily chart. It's viewed all the way back from the beginning of this trading range in late March. And so we've had two breakouts above that 6-week trading range in purple right there, and both of them failed. It shows, look, at this point, if you want to play the game, technically speaking, is it bullish or bearish? Well, bullish because you're above it. But we're also seeing there's just not a lot of buyers. Normally, when you break out of a trading range, it should be off to the races. This breakdown, as I mentioned, was pre-earnings and pre-Fed, so kind of take it with a grain of salt. And this is post-Fed right now. We'll see. We'll see where we go. But as I've been saying now for a couple weeks, any new high above this range would be any marginal new high, meaning not a super high that goes up 5-10%. That's going to burn through the divergences. Any slightly higher high will only simply extend the divergence and continue to be a divergent high. And from my experience, many years of it, breakouts that occur with negative divergence and other factors, I'm seeing market breadth deterioration still, only a handful of stocks carrying this market up. That is a breakout that I would put high odds on failing. So that's that. And then if you go down, if you're day trading and active trading, you can go to a 5-minute chart. You see these levels. I've had this line here that was created back on the 20th of April. I haven't touched it. It's a support and resistance level that the Qs are bouncing on. Tried to spike it here. That was intra-period. It was a 5-minute chart. That was not a breakout. It was an intra-period break. Never closed a 5-minute above it. And it's acted as support. So this is your next sell signal. And that, not by mere coincidence, comes in with the same levels I just showed you on the 30 and 60-minute charts. So there's your levels to watch. And then, works that way. If and when that breaks, you head down to the next one, probably get a reaction and work your way down. Okay. So that is your update on the indexes. I'm focused on the Qs because I think there's a lot of hot air in the Qs and a lot of downside potential. Let's talk about inflation and that whole thing. So on right side of the chart, on the under resources, you go to the top menu of the site. Resources, you go to tools of the trade and then click on economic calendar and you'll queue up the economic calendar. I already here click on the report for the day. So this is the CPI tomorrow. It's going to be released at 8:30 a.m. Eastern time, an hour before the market opens, and it tells us right now that the consensus is an increase of 0.4% month over month, and year over year an increase of 5%. And there's your consensus range. X food and energy is right in line with the general consensus of the entire CPI, and you can see the year over year in food and energy. So this is my inflation indicator. I've covered many times since this whole thing started, and if Powell was using this, and it's not the be-all end-all. This is DJP, Broad-Based Commodity Index. I know if you followed the site, this is repetitive, and you're saying, hurry up, Randy, but there's always new subscribers and people coming in. This is, in my opinion, one of the best broad-based commodity ETNs because it's not as overweighted in energy as some of the others. Now, energy does have a higher weighting in the CPI, so it's pretty darn accurate. Again, one good measure to use. And this is something that Powell and company were just, when they were blinded to in their denial, transitory inflation thing. If they would have just been watching this, instead of pivoting here, they would have seen that inflation was there. And it was priced in. It was a bullish technical setup. But anywho, and you can see inflation has been falling. So these boxes here I visited from time to time, and sometimes I didn't box them in. I just showed you. They show you the drop in the commodity index, again, broad-based. Now, what this doesn't include, and the Fed is actually watching more now than before, is the employment situation. So that's a big one because if you continue to have low unemployment, everyone's employed, you're going to have a wage inflation. That's something that's not included in here. I want to throw that out. Nor is housing, and you can go to Zillow, Redfin, all these sites, and look at trends there. That's also more dated information. The home sales are reported every so often, same thing with employment data, whereas this is a real-time indicator. Tick by tick, minute by minute, especially during market trading hours, and in many cases around the clock. If you're looking at futures, you can see what the price of corn, wheat, oil, gold, everything's all in here. And so this is, again, what I call my real-time inflation indicator with that caveat. It's not all-inclusive, but it's largely inclusive. And so that was last month right there. This is April in the purple box. And what I did, I shifted out. You can see here, I'll put my crosshairs up. That is right here, this green candle, where my crosshairs are. That's the first trading day of April. And this is the very last trading day. So overall, you can see that we went up and then we went down. To me, again, not backing out, any wage inflation, services, and things like that. that aren't included here that would indicate more of a flattish CPI, which, if so, and remember, if we come in anything under 0.4%, that's below expectations on month over month, and anything under 5% year over year. And if you look back year over year, again, this is not being the be all end all, not including every component of inflation, but we go back to, which I'm doing right here. Oh, no, I can't do it that way. I have to do it this way. I'm going to get my arrow tool. So we grab right in the middle, because remember, we went up, down. We kind of split the difference on about put a break even, if you will, on commodities. And then this is here's April, May right there. So we go right there to the end of May. And you can see a considerable drop year over year, at least on commodity inflation. So that, to me, indicates a lower than expected inflation number, which would indicate, if that comes through like that, a pop in the markets, which I believe will be faded, because any lower than expected inflation numbers gives the Fed room, or at least, again, the Fed's not going to comment tomorrow. I don't think there's anyone speaking. It doesn't matter what the Fed says. It's what the market thinks. The market right now and the Fed it's such a divergence. I don't think in history we've seen this, where the pros and all the market participants are betting a sharp drop-off, rate cuts already in the federal funds futures, whereas Powell's saying, no, I don't know what that is. We're telling you rates are going to be higher for longer. Anywho, just keep that in mind, that below expectations tomorrow in the CPI should be a net positive for the market, because it would help support the case for not necessarily a rate cut per se, but help solidify the whole pause thing, right? Okay, let's not spend too much more time on that. I wouldn't bet this again, because there's other things going in there, but it's just something I factored in my trading. Like I said, starting out with the Qs and everything else, at best I see a pop that will, if it's not faded, right away, would probably be faded by next week. And now that's what we're going to talk about here. So we are going to go over to the QQQ chart. This is what it looks like here. QQQ is really going nowhere, more so with the market. QQQ's gone slightly drifted. It's up at the top end of its trading range over the last month and a half, whereas SPY right now, the market, more of the stock market, is trading exactly where it was back in the beginning of April, right there, April 4th, so over a month ago. 1.2 months, and it's back where it was here, back where it was back in 2022. So the stock market's going nowhere, say what you want, but that's it. We're in that trading range, and the S&P again is just bouncing around. Nothing's changed in my longer term outlook, and again, I'm seeing whether we have a little more upside before then or not. I see what should amount to about a 30% drop for my next leg down, which I think is coming, and that's what I'm going to segue into here, the infamous RP vacation indicator here. Let's see. Let me have a board here somewhere, one of these boards. I have these all marked up. Got to be this one. There it is. Okay, so here's the bear market. The bear market in the NASDAQ 100 officially, if you want to say the bull market ended on November 22nd. That's also when the bear market started. It was a red candle, so we popped up, put in. I don't know if you can see it in the video, but I'm going to help you out here. Here, let me do this. I've already covered the divergences and everything that we have in place. Let me just park these indicators to the side here to give us more screen space. And I'll zoom in here. I'll drag this in. Look at that. There's that bearish engulfing candle right there, which I had mentioned and commented on that at the time. So let me go back. That was St. Lucia. Okay, so I was away from my desk, out of the country from the short trip. That was a wedding, the 21st to the 26th. And so let me show you what we were talking about at the time. What I'll do, if you care to reference this, I'll just post these links below, because this will kind of show you how these turns seem to come right around that time, or at least if not major turns, even the smaller turns, which are very profitable. and how we were positioned leading into those, even though I was away from my desk. So the kind of the takeaway is I think a big turn's coming, and what better time to finally have a definitive break from this trading range. Again, we had a little whipsaw to the bottom, two minor breaks to the top, first being a whipsaw so far, the other one we back tested today, so any more downside below today's lows means that second breakout that just happened failed. So when I say definitive, you'll know it. You'll know when we start moving away from that trading range and build on it day after day, with gains. So we're not there yet. Okay, St. Lucia, November 21st to 26th, right at the market top. And this is November. Again, I'll give you links to these. You can go in and look here. You can see DRIP is short energy, so started shorting energy, financials. And then in this video here, that would have been the one before I left town. Again, the 26th, I think I came back on a Friday, so that was my next update there. And in that video, I highlighted SPY, QQQ, IWM, all as short trades. We were all either active or waiting for sell signals. I believe they were all active. So we were shorting the top. And one of my favorites was Bitcoin. Bitcoin was covered in that video as well. And you can see here, let me give you the video or the chart here, GBTC. And that was right there as well. There's Bitcoin had just topped shortly before that, and I had some pretty aggressive targets. So we were, short at the highs in that. And again, point being, the takeaway is that is literally the turn in the market was right there at the top. And so, of course, I had some near-term targets, which I then went on to extend and provide my longer-term bear market targets, which several have already been hit, and we still have at least one more for what I call the initial leg of the bear market down before the next rally, and I think that's the one coming up. Okay, let's fast forward. Again, you can check on all those posts if you want. Maui was my next vacation. I was out of town from the 14th to the 20th last May. And so let's look at that. Okay, I gave you a flurry of trade ideas back then, including nailing the bottom on the first big rally, covering the Amazon short, selling a little way down, then going long, turning around and going long at the top. We did that 2 or 3 times last cut, all the big rallies, every single one, all big double digits. There's been 3 of them in the bear market. And we were either short going down and or long coming off those lows. And then in that video, go check the last video I gave you, was 12th of May, in which I stated about 2.5 minutes into it, I was looking for a tradable rally. We were short, but then I had just reversed to long right here, as I said, covering all the shorts, and started taking longs. Said I was looking for a tradable rally, then another leg down, and I highlighted and stated in those videos, at least the last one on the 12th, it's the only one I checked, the mid cap, the small and the mids, yes, small caps were my favorite of the sectors at that point in time. That was, again, May 12th, right before I left. Of course, price targets were laid out, but let's look at that. Be May 12th right here. May 12th, nailed that bottom. And that was the sector, the index that I was most bullish on. And we certainly traded that. We also had a tradable bounce in NQ. You can see we bottomed out on that and bottomed out in the Qs. We caught that rally and went right up to the price targets. I believe it was right there if you check those. Again, it was small, and then reverse, got that next leg down I was looking for there. Let's see if that was over. Is that the 12th right here? I'll have to scrub, but I checked them out. We were gaming that, but the turn came. We had this little turn here. That was right before I got on the plane, that last post. Got that leg down, and then got that next leg up. Tradable rally I was talking about. That's right. That's what it was. Target was up to about 315. Caught it down. So here's the takeaway, guys. I don't want to be redundant on this, but there are a lot of turns here. And the Keys, that was on my next trip. I was out from August 19th to the 24th. And I just reference you back to this one too before we leave that 522. So this is right when I got back here. I want to show you this one. It was interesting. Where is it? May 22nd. Case for a substantial stock market rally still intact. So that was, we went down. That's where we started going long. IWM never looked back. Had that rally. QQQ stayed there, and so I got back and gave it to you right there. I'm gonna crosshair it. 522 was a weekend. It was between this red candle here, right there, and that green candle. And so I reiterated my case for a stock market rally, hit the targets almost to the button, and that was all I was looking for, a rally and back down. So these are big inflection points, at least for me. And again, that's the takeaway. I kind of started noticing every time I'm going on vacation, like it's almost seems like it's coming with this trading range. I see a big move coming. It's going to take me leaving my desk. And of course, my wife will wonder why I'm sitting there on the phone or the computer all the time. Although this time around, like last year, we have a lot of excursions. So guys, I will not be able to get a lot of updates out to you. We've got all kinds of things booked up on this trip, and it's not to mention a day and a half of travel to and from Kauai. All right, Keys trip, and then I'll wrap this up after these two. Okay, Keys, August 19th through the 24th. So this would have been the last update I gave you right here. I think you can see these. August 18th, QQQ pinch between support and resistance. You can clearly see my targets, favoring a move down to, what was that, about 300 right there, followed by a bounce. Give you where the sell signals would come. And that was then. And that was, what was that, 323? Keys, where do we go? Right there. Oh no, I'm sorry. Actually, that was the 18th. That's right here. Let me zero in on the 18th candle right there. Calling for that sharp move down, which is exactly what we got. And then I made a point to interrupt my vacation, get a quick update out to you on the 22nd. Said I'm still on vacation, but QQQs are currently at that level, blah, blah, blah. What did I say? I went on and said that we could get one last, I said the odds are decent for one reaction here, followed by another leg down to my next target in the coming days to weeks. That was on the 22nd. And again, this is point here. I'm not going back to show you, hey, got these calls right. It just seems to be when the market moved. That was the 22nd right there, that candlestick, that right here. That was the low, that red candle. And that bounce doesn't look like much, but, it was a good 3% bounce, which is a nice, bounce trade, followed by, reiterating my downside targets, following a little bounce, and that was it. So we fell, hurricane came, we can go on and on. Hurricane started, hit, and we had to evacuate. That was September 28th, and I was off grid for a couple weeks. Very hard. I got updates out to you when I could, but had no power, no internet. We didn't have cell phone service for a while, and I had to tether I was out of internet service for 2 weeks, working off a spotty cell phone connection. But we'll just check that, and then I'll show you. So we'll get to this where we're at now. Okay, this is where Hurricane Ian took me offline. It hit on the 28th, made landfall. So this was the last update I was able to get out to you for that month. And that was NQQ and QQQ 60-minute chart, overhead resistance levels on September 27th. And here we go. Preferred bounce scenario, NQ. I've got QQQ chart up, so I'm going to use that. I had us bouncing to at least 280. All the way up to 286 right there, followed by another leg down. Again, that was September 27th. That was then, this is now. And that was, let's see where we were. September 27th was right here, this green candle. And we bounced right up from there, hit that, what is that, 280, about right there. You can go across 284 and change. So that was the going back to that, my preferred target, a darker, brighter arrow like that. That's the preferred scenario, and that's about right where we did. We almost split the difference there between the right in the middle, really, to be honest with you, between that R1 zone and the max bounce target, and then got that other leg down. So that's it. And again, you can see these inflection points. That's why I did these circles. Again, coincidence, maybe. Seems uncanny. It seems the market wants to wait for me to be away from my desk to make these big moves. But the end of the day, so there's my. I'll be out. We fly out Friday morning early, so I'm not going to be here. Thursday will be the last update I can get out to you. So that's why I boxed it in. That's when it begins. And so who knows? If we see, maybe the CPI pops. The market tomorrow, we have a little pop, and then they fade that and drop. And the big sell will probably come when they fall back in the range, and then again out at the bottom of the range. What I showed you earlier, there's the trading range right there. There's that one whipsaw pre FANG earnings and pre FOMC, followed by the two breakouts. So if the RP vacation indicator works, there's your window, folks. That's when the fireworks should happen. So it'll torture me while I'm buzzing volcanoes in Kauai in a helicopter or whatever excursion we're doing at the time. And so yeah, that's when it should happen there. Anyways, if this continues, so a major inflection point would mean the next leg down, like I just said. I don't know. I paused the video recording. I don't know if I got that, but this is when I don't know if the recording captured that. I'm sorry. That's when I leave on this Friday, gone. So I'll get a post out to you on Thursday, the last post, last updates, and we'll see if that's the turn, whether we get a pop before then or not. So the way that I trade when I'm not in front of my desk, especially, and this is a takeaway for any of you part-timers, anyone who's not doing this full-time, or a big or, even full-timers. If you're new to this, maybe you're retired, or you quit your day job because you're making enough money trading. I believe one of the best tools in trading and investing. Well, again, especially for investors that don't have the time to be in front of the computer all the time, are OCO orders. Some brokers call them OCOs, others call them OCA. It means the same thing. One cancels the other, or one cancels another. I haven't seen a broker that does not offer those. Sometimes they're under conditional order types. And what it is, when you enter a trade, you're going to have two things. You should always have a trading plan. What's your price target? For me, and again, I active trade. I show the 5-minute charts, 15-minute charts. I wear different hats and different accounts. I have swing positions and trend positions, and in some accounts I'm actively trading. But I'm going to speak to the swing and trend trader for that 30% drop that I'm calling for, which is going to take us beyond the lows. An OCO order, I'm going to just use an example here, will be, let's say you entered it today and you figure they might try to pop this range or not. But either way, if you're targeting a 30% drop, you could easily give yourself a 10% stop loss, and that's still an attractive 3-to-1 risk-reward ratio. So you'd be all the way up here. Now, personally, I don't think that's needed. It's not the one I would give. It's an attractive risk-reward ratio. But I think if we pop much more than this, I've talked on this many times, this is my max potential bounce target zone where things start to change for me. If we take out those August reaction highs in QQQ and SPY, we're going to take out some key Fibonacci levels, a 50% fib of the entire bear market. So to me, this is really a no-go zone. It doesn't obliterate the case that we're still in a larger bear market with more downside to come, because you still have major reaction highs and you still have the previous highway over here. So there's a myriad of possibilities. I'm not going to sit there and tell you all that. Unless we take out that high, we could still be in a bear market that just plays out longer. However, with that being said, near term, like I said, I'd have a hard time to chalk a move up above that 325-ish level is anything but bullish. So therefore, where I'm going, so if you believe in that 30% leg down coming up thing, that's only about 3.3% up to that level. Give it a little room to allow for a stop raid. That's just a common thing nowadays. They'll pop the stops. They know where all the stops are. And ideally, I like to set my stops on a closing basis. That's one thing. Maybe you can do that with conditional order types, but that's more of a manual thing for me. So, every night, even on vacation, you're back at the hotel, you can check in. But let's just keep it simple. So let's say you want to put a stop there. Let's say you give yourself a 5% stop. You put an order in, stop loss order, buy to cover QQQ short at 339, whatever that is. And so if it pops above that level, you're going to be stopped out. And then you have a buy to cover limit order at your price target, which in this case for me, my next price target is all the way down here. I told you minimum. We've already hit that level there, so I'm targeting now and move down to about 235, 236. So I'd have a little bit above that a buy to cover limit order, and that would give me that and showing here about 25, 26% downside. And so what happens with an OCO, if your stop loss order is hit, it will automatically cancel this order. So you don't have a standing order that's at risk of filling. Now, obviously, that's far away. It wouldn't happen. This is a long-term trade. But I use this a lot in day trading, active trading, when I have tight orders on both sides. And they're beautiful because if I need to, if I'm sitting in front of my desk and it's, let's say a day trade, and it's playing out longer than I thought, I wanted to run out and get an errand done, I can go ahead and leave knowing that I'm either going to have my price target hit or I'll be stopped out. And if you don't have OCOs, what happens? If one gets hit, the other's still standing. In a volatile market, you can have that other order filled. So anyways, that's what the OCO orders do. I always set them good to cancel. That means they're going to stay on the system at least for a couple months. And again, so not only do you have that automation where your target's going to be hit or you're going to be stopped out, but more importantly, guys, especially, and trust me, I've been doing this a long time, and I'm sure anybody listening to my voice will agree, one of the hardest things to do in trading when you're using mental stops, you're going to second guess your position. You're going to give your losers a little more room. You think that's going to turn. You're going to make the case. And the next thing you know, you have losses that are far exceeded your initial stop allowance. So what OCO orders do, other than free up your time so you don't have to be in front of the computer 24/7, or at least when the markets are trading, is discipline. Set it and forget it. You have a trading plan. You're willing to lose X if wrong. That's, let's say, 1 unit of loss. And to target, whatever unit, 2, 3, 4 units of profit, 3, 4 to 1 risk reward ratio. And that's it. And you put those orders in, and you're not going to have those mind games where you're second guessing your position. And so if nothing else, discipline for those that lack it. That's why I like those OCO orders. All right, so I'm going to wrap it up here, guys. I know it was a long video. Well, not super long. This one was only 30 minutes. And I will be curious to see if the pattern continues of market waiting for me to walk away from my desk to do what it needs to do, or at least have that next big inflection point. And I mentioned before, it could be a pop-up. Well, that wouldn't fit with this pattern, because like I said, the reason I want to do this is not say, hey guys, every time I've gone on vacation the market's made a big turn. It said, hey, we were right ahead of it. The technicals told me that's the way it was going to go, and it took me walking out of the door away from my desk for that move to happen. So just like in the keys, I think I did it back here, at least in a couple of these. Absolutely, if I'm in on my phone or on my computer back at the hotel and I see something that develops, I will get updates out to you. That I will always do to the best of my abilities. I just, like I said, most of this trip will be booked with excursions, not to mention 3 flights. And, Hawaii is halfway around the world from Southwest Florida. And unfortunately, we have an international airport that goes nowhere but to the major hubs, pretty much, Atlanta or wherever you got to go through. It's very, very few direct flights to anywhere but the major hubs. So therefore, it's usually 2 or 3 planes to get where a lot of folks can jump on one plane and go somewhere on a nonstop. All right, guys, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.